I also advocate gold and silver, and I'm delighted by the fact I'm making systematic purchases myself of gold and silver. I'm delighted to see the price gains moderated so that I can buy more cheaply. For me, gold is insurance. Gold is insurance against both inflation or the depreciation of the purchasing power of the U.S. dollar, but it's also insurance against declining faith in institutions and trade. The U.S. dollar is a promise to pay; it's a receipt. Gold isn't a promise to pay; it's payment. You don't have to trust the counterparty because you have been paid. You have the asset.
In a recent exchange with a deep dive, Rick Rule, CEO of Rule Investment, delved into various financial facets, shedding light on inflationary concerns, asset preferences, and the evolving junior mining landscape. Notably, he discerns a newfound sensibility prevailing within junior mining markets. Rule elaborates that holding onto gold and silver acts as a reliable safeguard against the eroding value of traditional currency. Embracing modest price fluctuations enables individuals to acquire these precious metals at more favorable costs, thereby facilitating gradual accumulation over time. In a recent twist of events, gold prices experienced a significant downturn, hitting a 5-month low. This slump was triggered by the strengthening U.S. dollar and the concurrent rise in government bond interest rates. Positive economic indicators led to speculation about the Federal Reserve's potential tightening of borrowing costs, prompting this shift. Intriguingly, silver, despite its current dip, retains its intrinsic purchasing power when set aside, standing in stark contrast to fiat currency. Both gold and silver, Rule affirms, serve as enduring repositories of genuine value. Silver's current undervaluation, however, stands out. While gold has recorded a 4% gain this year, silver's value has witnessed a decline exceeding 5%. Amidst this backdrop, optimism abounds among analysts regarding silver's medium-term potential. Meanwhile, gold's anticipated volatility remains anchored to shifts in U.S. interest rates. Encouragingly, early signals suggest that gold's price fluctuations might be stabilizing, as hinted by Matt Simpson from Citi Index. Just before you watch the Rick Rules interview and learn more about market trends, consider subscribing to our channel and give this video a big thumbs up. In this intricate landscape, Rule underscores the significance of astutely chosen junior gold and silver companies. He advocates identifying gold projects boasting in-situ values of $10 billion and silver projects with a minimum benchmark of $2 billion, equivalent to 5 million ounces of gold and 80 million ounces of silver.
A lot of people, I guess, buy gold for greed reasons. They read stories about the decade of the 1970s when the gold price went from $35 to $800, $850. I buy it for very different reasons. I buy it for fear reasons. I think that the junior equity market will, in fact, rebound without an extinction event first. I think that we are coming into a discovery cycle, and we are now beginning to enjoy the data that's been developed over 10 or 15 years as a consequence of the capital that was raised in the 2005 to 2011 timeframe. So we're going to start to see some discoveries. We are also going to see takeovers of good juniors by larger companies with lower cost of capital. I think, too, that there's an increasing sense on a global basis that ex-recession, which we may or may not have, that a whole range of industrial commodities all have to go higher. We've underinvested in those commodities for a very long time. And the urbanization of the poorest of the poor will, irrespective of what we do, increase demand for those commodities in an area where there isn't sufficient capital to bring on new supply or sufficient time. I think that'll be reflected in the market. I think, too, that if we do have a recession or we do have a liquidity event of some kind, that the official sector response will be to absolutely pour fiat currency at it, will absolutely positively be to inflate. And I think that they are approaching the place where that becomes pushing on a string, all of which means I think that people are making a mistake not paying attention to the high quality junior gold and silver companies. I'm not talking about, amalgamated moose pasture or consolidated orangutan, those penny dreadfuls where they're purporting to look for gold, but they don't happen to have any. I'm talking about the higher quality juniors run by the good people, people who have the third dimension. They have a drill hole into something that is a deposit and may become an ore body. I think those stocks will surprise people over the next 2 years. I think, too, that the market is beginning, the junior market investor universe is beginning to bifurcate. You are seeing the people who have populated, perhaps polluted, the junior mining investment for the last 15 years, people who are really traders, people whose attention span required them not to hold stock over a long weekend. You're seeing them replaced by mining companies themselves, by good seasoned speculators. Warren Buffett once observed that the market itself is a wonderful mechanism for transferring wealth from the impatient to the patient. And I think what you're beginning to see in the junior space is, if not the death of dumb money, the end of dumb money, and the replacement of that by smarter, more patient money. I like to flatter myself by considering myself part of that latter community.
The notion of a unified currency within the BRICS group raises skepticism. Rule believes it's unrealistic, citing trust and gold contributions needed for its success. Economist Jim O'Neill calls the idea ridiculous, doubting a BRICS central bank's feasibility. Contemplating a BRICS shared currency draws divided opinions. Rule deems the concept unrealistic, highlighting the need for trust and gold contributions. Even Wall Street, the financial hub of the United States, doesn't seem concerned about a new currency becoming a strong competitor to the US dollar. Rule points out that the adversary of the US dollar isn't in foreign capitals like Beijing or Moscow, but rather in Washington itself. Economist and Currency Wars author Jim Rickards has warned that despite China and other nations intensifying their efforts to reduce their dependency on the US dollar's biggest threat comes from the Treasury. Let's get back to the interview.
I don't ultimately believe that they trust each other enough. And I think that what they're proposing now would be best described as a settlement scheme rather than a currency. A currency suggests, particularly a gold-backed currency suggests, that those nations would all subsume their national currencies and hence their national fiscal policy to a common policy. They don't have enough gold collectively to secure a currency that would be large enough to handle all of the currency needs of their citizens. If they are proposing, rather, a gold-backed settlement system so that at the end of the quarter, if, as an example, the Russians had sold the Chinese $10 billion worth of doodahs, and the Chinese had sold the Russians $12 billion worth of doodahs, and there was a settlement balance of $2 billion in China's favor, that they would settle it with this BRICS currency, which would ultimately be convertible into gold. The problem with that, Cassandra, as I see it, is that in order for them to trust each other, all of them would have to contribute their gold into the settlement bank so that the person receiving the settlement could be sure to get settlement. I can imagine the Russians, as an example, having a trade deficit with the Chinese, and the Chinese saying, "We'd like our gold, please." And the Russians would say, well, here's some bricks, not gold bricks, but bricks. So no, I don't see that happening. I do see the eventual development of bilateral and multilateral settlement mechanisms outside the US dollar. I see that simply because the US government has been so odious in terms of applying extraterritoriality, American aspirations, goals, whims, through the SWIFT settlement system, and then later by, in effect, canceling Russia's claims to their U.S. treasuries. The United States has made it both unpleasant and dangerous for many countries, to store their foreign reserves in U.S. treasuries because of the U.S. predilection for stealing them. And then, of course, weaponizing the SWIFT banking system, which isn't the property of the U.S. One of the things I like to say when asked questions like this is that the enemy of the U.S. dollar are not in Beijing or Moscow or Tehran. The enemy of the U.S. dollar is in Washington.
Precious metals like gold and silver are often seen as hedges against inflation because their value tends to hold or even increase during times of rising prices. This is due to their intrinsic value and limited supply. What role do you see precious metals like gold and silver playing in safeguarding value amidst changing economic tides? How do you envision the future of currencies and their impact on global economies? Let us know your thoughts in the comments. If you liked the video, please subscribe to our channel, and currently 93% of viewers haven't subscribed yet. Help us reach 2,000 subscribers.